This is the 401k Fridays podcast, and I'm your host, Rick Unser. If you're a retirement plan fiduciary or administer your company's retirement plan, you've come to the right spot. Our format is pretty simple. In each episode, we select a timely and informative workplace retirement plan topic, we pick the brain of an expert guest, and provide you the hard-to-find perspective you need to make informed decisions that benefit your plan, your employees, and company. Now here we go with this week's episode. This episode is a perfect example of one where I get to use the podcast as my own research lab and learn right alongside you. Environmental, social, and governance investments, or ESG, or is it ES and G strategies, is a new topic here on the podcast and one that I've been looking forward to digging into. Their popularity seems to have ebbed and flowed in the 401k investment world, but as a strategy, it's definitely here to stay. My guest, Sean Kenny, a CFA and managing director for MFS Investment Management, is, as you'll hear, incredibly knowledgeable and passionate about all things ESG. We hit on a few familiar themes, such as whether the decision to add an ESG strategy or strategies to your workplace retirement plan should be done by evaluating different products or through a broader process. We also discuss who in your workforce ESG might appeal to, the fiduciary and other implications for offering ESG investments in your plan, and close with some solid takeaways and next steps for employers. Before we get started, if you haven't been to our website in a little while, be sure to check it out. Not only have we updated it recently, but we also have a dedicated page for each episode, which includes guest pictures, bios, links to prior podcast episodes, and more. For example, if you want to learn a little more about Sean and his background, go to 401kfridays.com/Kenny, Kenney, and check it out. Pretty impressive. And now, please enjoy our conversation about ESG investment strategies. Well, Sean, thanks for joining me today on the podcast. I am looking forward to tackling new ground, a new topic, however you want to phrase it, and can't wait to hear what you have to say about ESG investments. So thanks for joining me.
Yeah, thanks for having me, Rick. I appreciate it.
Well, I guess let's just start with the obvious, or maybe it's not so obvious, but what is ESG, or is it ES and G investments, and why are they getting so much attention in the retirement marketplace right now?
Yeah, it's a great place to start because it is the alphabet soup of our industry, and there's a lot of confusion around this topic, largely just because of the naming convention of this topic. So you can think about this in terms of socially responsible investing. You've got the terminology out there, sin stocks, impact investing. You've got phrases like negative and positive screening, and then ESG, ES and G. So there's a lot of different ways to communicate this overall theme to the market. And so I would really simplify it by thinking of it in two ways: product and process. There's a product component to this conversation, and you can think about a product component in terms of negative and positive screening. So an example of a negatively screened product would be like an X tobacco, X firearms, X fossil fuels type of a portfolio. If you did like a quick search on Google for ESG investment products, you would probably see these kind of products out there. You also might see positively screened products. So you might have a product that is looking to influence the world in some positive way, like maybe it's to invest in poor areas or to improve the health of a particular group of people or demographic. So negative and positively screened portfolios are the product solutions in this market, and that's where most of the default is in the market. So if you went to a rating service like a Morningstar, for example, they'll often publish their top 10 ESG products in the market. This is what they're generally looking at. It's negatively and positively screened products, and that's where most of the market focuses. So that's the one part of it, is the product side. The second is more process oriented, and you might hear the phrase integration, ESG integration, And when you hear that, that's where the industry is talking more about process. So you might have some long-term investors that are looking to invest in high-quality companies over a long period of time. And so they'll be, as a natural part of good research, they'll be incorporating ESG factors into their investment process. So they're going to want to understand factors like, is this company a chronic polluter? And if they are, perhaps they'll be hit by a sanction in a local market, and that could negatively impact their brand, and that'll hurt the business. Are they perpetually bad stewards of their labor force, and might a lawsuit impact their business and hurt them long term? So when you look at ESG as part of the overall process, most investors are focused on material ESG factors that are material to that business. So it might be material to a hotel operator, would be wildly different than what's material to an energy company, for example. And so I would really simplify this if I was on an investment committee overseeing a retirement plan or long-term assets on behalf of a group of stakeholders. I'd be thinking about it in terms of product versus process, and what is it that you're really looking for. So I think that some of those naming conventions and the confusion around this topic can be dispelled through some simplification in that way. The second part of your question, I think, is really an important question to answer. And candidly, I think it's ESG, which is kind of how I'll refer to this throughout this conversation. ESG is about answering a much bigger question. The CFA Society a number of years ago published a big report that they called The Future of Finance. And in that report, they stated that the investment profession runs the risk of becoming irrelevant unless it aligns its interests with those of its clients and demonstrates that it serves a clear and meaningful social purpose. And the reason the CFA Society is highlighting this is that our industry, the investment industry, investment managers, investment consultants, and advisors, and even the investment committees that oversee retirement programs on behalf of their employees, is intrinsically a trust business. And what's becoming evident is that our clients and the folks that are investing are looking for more and more validation that investment is more than just performance. And so my view is that this ESG topic is really just a bite-sized chunk of the bigger question, which is how are we in the investment business going to start answering this bigger question, which is what is the clear and meaningful social purpose that we have in this business. And the millennial generation is really forcing us to answer it. They're forcing us because, one, they're becoming very relevant. They're becoming a dominant force in the workforce. They're becoming the decision makers in a lot of workforces. They're going to be taking over a tremendous amount of intergenerational wealth from the baby boomers. Some estimates are over $30 trillion in wealth will be transitioned to Gen X and the millennial generation. And they're vocal. They're a very vocal group. And what they're saying to the investment community is that we want our investments and our careers to be aligned with our own personal values and beliefs. And so again, as we have this conversation, as we think about ESG, my personal view is that it's much more of a conversation around alignment. How are we aligning the way we talk about what we do in the investment business with the values of our clients? How are we aligning the way that we're conducting our business and the practices and the way we bring people into this industry and attract clients? How are we communicating what we do with those important stakeholders? And so it's much more of a conversation of alignment than it is necessarily about just ESG or how our portfolios are impacting the environment or the social environment. It's a much bigger question.
That was awesome. And let me try to pick away at a few of those things. And I want to stick on alignment for a second, because when you talked about product versus process, I mean, to me, those seem like wildly different approaches in this market. So if you're an investment committee, how do you work with your advisor, with your committee, with your service providers to, I guess, even just start that conversation of what is important to us, and are we better served by, and I'm going to butcher the words I think here, but are we better served by a negative or positive product, or a investor or a manager that uses ESG as part of their process?
Yeah, it's a really difficult question, particularly for defined contribution plan sponsors. And we've been having this conversation for many years with these investment committees. And I would distill it down into a really simple decision mode. What is it you're trying to satisfy for? And if I'm an investment committee overseeing a defined contribution plan, you have to ask yourself, are you looking to satisfy a set of stakeholders that have a very homogenous set of beliefs? So they might all be coming to you and saying, hey, we're a clean energy company, so we don't believe we should be invested in fossil fuel companies.
Right.
We don't believe that we should be investing in companies that are negatively impacting the environment. And if you have a participant base that's very united on these set of beliefs, then a product solution might be the right answer for you. You might be looking at negatively screened products that will divest from fossil fuels. You might be looking at positively screened products that will really provide funding for clean energy. The challenge for DC plan sponsors is that often that's not the case. For DC plan sponsors, often you have a very heterogeneous set of participants and beliefs. You might have one set of participants coming to you saying, I care deeply about human rights violators and don't think we should be investing in places of the world like Iran and Sudan. Others might be saying, I care deeply about the environment and don't want to be investing in companies that kick off a lot of carbon. Others might be more interested in water shortage, others tobacco and firearms, and often these can be fluid, so that sort of the media narrative of the day might capture the attention of your participants. And so one year it might be firearms, and the next year it might be board equality. So it's really difficult for plan sponsors, in my opinion, to implement a product solution within a DC plan unless you have a set of stakeholders that are very united on it. So our view is that often case in defined contribution programs, the solution would be going after an integrated approach, but importantly, hiring managers and partners that can execute on a more integrated long-term ESG approach. But the important thing for plan sponsors is then be able to communicate that approach down to their participants so that those folks that do have a various set of different beliefs can feel satisfied by a set of managers or partners that are executing on a more integrated approach towards ESG.
And as you're saying all that as well, I mean, with the heterogeneous nature of a lot of employee populations, there's also, I mean, just with amongst the folks that might sit on a retirement plan committee, you maybe have 3 or 5 people that are part of a decision-making body for the retirement plan. There can be a lot of differences of opinion there. So, I mean, one thing that just, as you were talking through that, one thing that really came to mind is, all right, well, there is potentially an infinite number of outcomes here. We want this in, we want that out, et cetera, et cetera. So is there really an ability out in the marketplace to customize based on wants and needs? And if so, is that only for very large plans with very large pools of assets that could be shepherded towards an ESG strategy? Or is it really, if this is something you're interested in, are you trying to filter based on existing products and try to get as close as you can to what you believe the wants and desires of your population are?
Yeah, so the customization typically happens in the separate account space, which, as you know, is generally very large pools of capital, and it's somewhat tough in the defined contribution space unless you're using white label strategies and cash managers. So it's not very often that customized ESG products get created in the defined contribution space, but you do see it in the pension space quite a bit, particularly in the large market. Now, we work with a lot of government plans, for example, state plans, county plans, municipal pension plans, and they might have, based on their state legislation, some sort of divestment requirement. And in that case, it's pretty easy to screen those out. There's a lot of service providers that are out there that are tracking this stuff and that we just subscribe to and make sure that we can execute on that on behalf of our client. But for defined contribution plans and certainly for small and mid-sized employers where that really isn't a viable option, it's really difficult. And even in that large market, if you don't have that, either some legislation to follow or some very clearly consistent set of beliefs among your participants, you end up screening out virtually everything, right? Because if you're trying to satisfy every demand out there, even if it's 5 different people on a committee, you could be addressing a number of different issues that are important to all of them. And then next thing you know, you've screened out half the universe. And so then it becomes very difficult to be able to satisfy the performance requirements and the risk mitigation requirements that you might need to manage a portfolio credibly. So again, my view is from an ESG perspective is that we as an industry and even ourselves, we need to do a better job of transitioning this conversation away from a product can solve the problem into much more of a how are we going to communicate the way we conduct business to make sure it aligns with the growing interest of the millennial generation that cares about environmental and social issues. And my belief is that most long-term investment managers are doing it. They're assessing, particularly long-term managers, the short-term ES and G factors are less relevant. It's more trading. But if you're truly a long-term investor looking out over market cycles and longer periods of time, you care about these factors in a material way. The question is, can you articulate that so that you can demonstrate to your clients that we're aligned? What you care about is making sure that the investments that you put into the market are contributing to the broader wellness of the society, and long-term capital that gets put to work with high-quality businesses that conducts their business responsibly around the world, that's aligned with what you're trying to accomplish. And we're passionate about it at this firm because we have a very clear purpose here, which is to responsibly grow and protect client capital to meet their long-term goals. And so our view is if our goal, our purpose is to responsibly invest on behalf of our clients, you better know the companies you're investing in, you better understand the stakeholders that impact that company. And so ESG and understanding these material factors to a business is just part of our DNA. And again, we in the industry need to do a better job articulating that to the end participants and plan sponsors.
All right. So here's my other thought on this, and I feel like I saw something come out from the DOL about it. So I'd love to kind of have you kind of address that as I try to weave this question. So I get it from an ESG standpoint. Hey, there's a demand. There's people want to feel aligned from a social standpoint, but on the other end of it, you've got a lot of people out there that are looking pretty hard at numbers. And, if a non-ESG strategy has historically performed better or is better positioned than an ESG strategy, and as a committee, as a fiduciary, you're trying to balance, all right, well, hey, yes, we want to align with our population and do, some social or environmental or other good in the world with the investments that we're choosing. But at the same point in time, we have this responsibility to provide high quality investment options that produce results for our population to help them on their journey towards retirement. So as people are thinking about this, how do you balance that, and what are some thoughts you give to people as they kind of head down this road in an environment where fiduciary responsibility is a very real and very serious consideration anytime you're choosing an investment option?
Okay, so I'll answer that in 2 ways. I'll first address kind of the regulatory component, which is really driven by the Department of Labor bulletins that have come out over the past decade. And then I'll address more of the fiduciary, I call it like a fiduciary mental model that we take into the conversation.
And as you'll find, I like to ask complex questions, so I love that you're breaking it up already. So carry on.
You like to pack a punch, Rick.
Exactly.
No, that's great. So the Department of Labor piece, I would say the DOL has been really trying to give guidance to DC plan sponsors. It's been fairly unsuccessful, unfortunately, but they're trying. And so just to break it down a little bit and provide a little bit of clarity onto how this thing has evolved, because if you're a DC plan sponsor, you certainly care about the Department of Labor's view on this stuff. So in 2008, there was a field assistance bulletin that the Department of Labor came out with that kind of discouraged investors from considering ESG factors into the conversation. And in 2015, a field assistance bulletin clarified for DC plan sponsors that fiduciaries can't accept a lower expected return or greater risks, but they can take ESG benefits into account as tiebreakers when the investments are otherwise equal. So it provided some clarity and gave a little bit of gasoline to the ESG conversation in the DC space. More recently, however, in 2018, this year, the DOL's leadership reversed course a bit and warned plan sponsors not to place too much emphasis on public policy objectives when they select their investments. And they can't put too much priority on ESG factors when making investment decisions. Basically, the way they phrased it was they have to treat ESG factors as economically relevant to the particular investment choices. So what they're saying is that while you can think about and consider ESG, at the end of the day, you've got to make investment choices based on the performance and the risk metrics, not based on some social or political or ESG agenda. So that's kind of put a bit of a halt on the ESG momentum in the DC space, and there's a little bit of questions that we're getting from our clients and stakeholders in the space to try to figure out what it all means. So that's the Department of Labor perspective, and I wish that I could offer more clarity on exactly what the end game is there, but that's kind of where we are.
But I guess from a simplistic standpoint, I guess coming back to one of the comments you made earlier, if a committee has a very complex restrictive screening process that is trying to solve for many different concerns, and I don't know, let's just, you take an index that maybe that index has 500 investments typically, and all of a sudden now you've kind of screened it down to there's only going to be 30. Maybe that's too restrictive. And, despite it being, maybe it aligns with your employee population, that probably doesn't make sense from a fiduciary standpoint and, could impact returns, risk, etc. I mean, that's probably a little bit of an egregious example, but I mean, is that kind of the spirit of what you're saying there?
Exactly. So that's the spirit of it, which is you can understand ESG factors, you can use it as you're making decisions, but you can't allow it to drive the decision-making process for your portfolios. So, I think for a plan sponsor or an investment committee, really it's going to come down to you have to have the economic interest of the plans first. It's that simple. And if you have the economic interest of the plan first, then ESG can really only be a byproduct of your decision-making. And a good example of that, Rick, is there's a number of examples where good long-term investment managers, active investment managers, aren't looking to execute on ESG principles as a part of their investment objective, but because they are focused on material factors and they're looking at the underlying companies and evaluating these things as a part of their process, the result becomes a very highly rated ESG product. And it's the same way investment committees should be thinking about it. If you're putting a good process in place around investment selection, if you're focused on long-term performance, which certainly DC investors and investment committees should be focused on really long-term performance and selecting good underlying managers and partners to deliver on that, then the byproduct can and likely could be strong ESG product. So that's one way to think about it. The other part, Rick, is I mentioned the mental model or the fiduciary part of this conversation. We, a number of years ago, spent some time with MIT. MIT's literally across the river from us here in Boston. They're in Cambridge. And they have a research center called their Sustainability Initiative. And we spent a good amount of time with them as we were trying to think about how do we go out and talk to our clients about this issue as an investment manager that really focuses on integrating material factors into long-term decision making. We were trying to figure out how do we engage the market in this conversation in a really authentic way and not some marketing spin that would be insincere. And as we spent time with them, one of the things that we recognized and they helped us understand was that human beings are trained, particularly investors, are trained in terms of trade-offs. We think in terms of fight and flight, right? And investors think in terms of risk and return. There's generally a trade-off to these different things. And as human beings, as we engage in this conversation around ESG, we often take into this conversation this idea of a trade-off between performance and societal value or positive ESG. And so it is not an easy solution to that, but it's important that we recognize that. And we talk with investment committees a lot about just acknowledge that that mental model exists and that we're going to be fighting that bias as you engage in this conversation. Because once you recognize that, then you can start looking at, okay, how do we start overcoming it? What are some of the heuristics we can use to look past it? And one of those is really focusing on a long-term perspective, not prioritizing ESG, but building a process of selection, in our case, stock selection, in your case, in the committee's case, manager selection, where we can uncover good, long-term, sustainable organizations that we can invest in or partner with that can deliver the performance and risk characteristics that we're looking for. And so this idea that there's necessarily a trade-off is something that we have to sort of acknowledge and work through. And the reality is a lot of people look to the industry for data and academics for empirical evidence that by negatively screening there isn't a performance impact. It's almost impossible to prove that because these are very, very long periods of time. You have to evaluate it over. There's so many different things that impact investment performance that to isolate it to one or two factors is virtually impossible. So, I think it's more of a, you have to have the belief that these things matter over the long term. And if they do, and you have a process for understanding it and then communicating it to your stakeholders in a sincere and authentic way, that's the best we can do here. Because I don't think we can ever look to the empirical evidence to say that ESG screening isn't going to hurt your performance. As an investment fiduciary, it's a really tough thing to wrap your head around.
And another thing I'm just kind of thinking about as you're saying all this, in our world of retirement plan investments, we like to put things in boxes, whether they're large cap growth, small cap value, intermediate term bond, whatever it is. I feel like that, most retirement plans, that's kind of the way they're thinking. And just as a total aside, I had a really interesting conversation on factor investing a little while ago, which kind of influenced some of my thinking on that. But coming back to this conversation, if someone's looking to go down the path of offering an or multiple ESG strategies, is there a box they should try to fit it in, or is it more, hey, this is an equity ESG strategy, or this is a fixed income, or this is a balanced, which would be a blend between, equity and fixed income? Where does something like this fit in an investment lineup?
It's a really difficult question because I think it's going to come down to, for each plan sponsor, what is your objective? And for each one, it could be each one of those strategies, Rick, that you outlined could be credible. So you could choose an equity ESG maybe it's a global equity ESG portfolio for maybe there's a set of stakeholders that want ESG and you want to make sure that they have something there. You can give them a go anywhere global equity ESG portfolio and a go anywhere global fixed income ESG portfolio and call it a day. Maybe you've got kind of a split population and you want to offer two different menus, one that's ESG and one that's non-ESG. But ultimately, the challenge for DC plan sponsors is you have to articulate why you're doing it, right? So to be able to clearly articulate, not only as a committee to have clarity and conviction behind what you're doing, but then ultimately to your participants, because they're going to say, well, what's up with this ESG thing? should I expect less performance from it? Should I expect more performance from it? Is it going to be less risk? Or there's an ESG and a non-ESG lineup. Which one's better for me? And these are these are questions that the committee is going to have some clarity around answering. So I think it's really going to start with, it's almost like the governance of the investment committee. Starting, any good team starts with clarity of goal. And if you have clarity of goal and what your objective is in this conversation, then the answer becomes a lot more clear. The challenge is with a lot of team dynamics in general, we go towards the solution before we go to the goal. And what's happened in this conversation with ESG in this industry, particularly in DC, is the simple solution is just offer a product, because then you can say, oh, well, we have a product for that.
Yeah, check the box.
Check the box, exactly. And again, I pull it back to my opening comments, which is this is a much bigger conversation around alignment of purpose. And that's a really tough conversation. It's a really tough place to start, but it's probably the right place to start. And if you can start answering some of those questions, then the answer becomes much more clear. And, the answer for the investment committee and then ultimately for the participant becomes a little bit more clear, because it's not going to be a perfect answer for every participant.
Well, and it's funny you say that, because that's kind of where I wanted to take you, which was, I mean, correct me if I'm wrong here, but, we've got a committee. Okay, this makes sense. We feel like this would align with our population to have one or several investments in our plan that have this ESG component to it. So to your point, how do we find out what's important to our population? Well, the default answer tends to usually be a survey. So I guess maybe first thing is, is that a good strategy? And then one of the other things that come along with surveys that I know we deal with a lot when working with investment committees is, okay, well, what if they come back with stuff that we can't provide? Or what if we come back with, all right, now that we have the survey data and we can address a lot of things that were in there, but to your point, there's not going to be a singular investment that's going to capture everyone's wishes and desires. So what do you do once you started to go down this path and you're like, oh my gosh, no how, no way are we going to be able to do this in a way where everyone's going to be happy? And are we inviting chaos into the mix when we've tried to do a good thing? As I like to say, we've just snatched defeat out of the jaws of victory.
Yeah. I mean, I think we should be treating it as another employee benefit. I mean, we're not always surveying employees for every decision we're making on the healthcare programs or some of the other, the parking programs that we have. And I'm not trying to make light of the retirement program, because the DC program is probably going to be one of the greatest assets an employee owns outside of their home. So it's a critically important benefit. But I think if the plan sponsor is trying to build something that will satisfy everybody, it's very, very difficult, and it probably isn't going to happen. And then you're going to overanalyze and become paralyzed. So, similar to what you might do from a healthcare perspective, you might look at the environment and say, how does this retirement program fit into the way we want to recruit and retain our talent and provide a secure and dignified retirement for our employees while also managing our workforce? How should we be thinking about the retirement program and the way we want to communicate and provide a benefit for our employees? And as you start answering those questions as a leadership team, as a committee, then you might say, okay, well, maybe it's not clear to us what our employees care about. If we want to recruit a generation of engineers, and that's really important for us, how are we going to provide benefits and communicate those benefits that will not only be the right thing for all of our employees, but also will help attract and retain the type of talent that we need to be viable into the future? Those, I think, are the questions that organizations probably need to spend more time on and less time surveying and trying to get every piece of data from their employee base. No doubt you need to get an understanding from your employees what matters to them, and surveys and some of the other ways that HR within companies get that feedback is an important part of the feedback process. But my personal view is more of the governance stuff that I just described is probably the better bang for the buck for leadership and for these committees as they're trying to formulate a view on this stuff.
So you've taken the leap. You've decided that you're going to go down the path of offering something in the ESG space, one or multiple options. So we've crossed that chasm. Now, over time, as a committee, one of the duties there is to monitor your investments. So how do you go about doing that? A year down the road, 2 years down the road, how do we know if this ESG strategy is working? Is it just, I don't know. I'll leave it to you as an open question. What guidance would you kind of give to an employer who's decided that they want to go down this path and want to make sure that they're doing their fiduciary duty to ensure that strategy is actually doing its job?
Well, I'll keep the answer really simple because based on the Department of Labor bulletin that recently came out, the answer is simple. Is it performing? Is the risk and return commensurate with your investment policy statement and what you would expect from any other investment strategy in that category? Full stop. That's the solution at this point. Because whether you're choosing that investment option based on performance and risk in conjunction with the maybe some ESG objective is really irrelevant. Again, the new bulletin is really focused on it's got to be economically viable on its own. And if it has an ESG theme to it, then that's fine. But it can't be a component part of the evaluation process.
There you go. Easy enough. So in the vein of kind of looking forward here, 3-5 years from now, where do you see ESG going? Is there a potential here that ESG could develop in one way, shape, or form, but maybe the way that 401k plan sponsors or defined contribution plans, maybe there's a different way that they'll need to be looking at that over the next 3 to 5 years. So I know that's kind of broad and nebulous, but I'm just curious about how you see those two things evolving over the next the next 3 to 5 years, just the broader ESG strategy and then how ESG kind of fits into the 401k or defined contribution world.
Yeah, so I'll probably make more of a hope than a prediction here, Rick. But my hope over the next 5 years is that the ESG conversation becomes much more about a conversation of alignment and purpose than necessarily a product. And I have some, I feel like there's potential for that because if you look over the past 5 years, this ESG conversation is actually a very global conversation. It isn't just in the U.S. It's vigorously discussed in parts of Europe, in Canada, and Australia, and it's actually much more widely implemented in those regions. And certainly more recently here in the U.S., which is by far the largest market out of all of those. But over the past 5 years, we've really seen a convergence of this conversation of ESG into more of an integrated conversation and moving away from it being a product into much more about how do you integrate these really important factors into decision making in portfolios, whether it's active or passive. And so, my hope and expectation over the next 5 years is that continues and we move away from this being really a marketing tool to attract capital and using it as some sizzle to try to gain a millennial generation's assets or differentiate at point of sale, which is really what's happening today, and moving much more into, over the next 5 years, answering this much bigger question around how are we in the investment business really aligned with this really important generation asking these really important questions, and how can we use ESG as a proxy for the broader message that we want to be talking about in the investment business, which is that putting good long-term capital to work and being selective in who you give long-term capital to as a company or with your investment managers that's a noble purpose. It's an important purpose, and actually does have meaningful impact on the way societies operate, the environment, and otherwise. So I do believe that over the next 5 years, if we had the same conversation, we wouldn't be as fixated in the industry on product. We'd be talking much more about how these things are incorporated into decision making, as opposed to selection between product A or product B, or measuring product A versus product B. I don't know how prescient that is, but that would be my hope and somewhat of an expectation.
And I love that. And I think one of the reasons that I was excited to tackle this topic and have you on was I do feel like that ESG in a certain way is kind of a bright, shiny object. And it's, some folks that are playing in the space are kind of trotting it out and, using that to attract attention and whatever the case may be. And to your point, typically when that happens, people tend to get into very product driven decisions. And I think that's translatable to what's going on in financial wellness. I think we've seen that in various other aspects in our retirement world, but that's one of the things I was really excited to kind of get a lot of input from you today on, which you really delivered, is just what are some of the bigger things that people should be thinking about other than here's a bright shiny object that's an ESG and strategy. We don't have one of those. Let's put it in the plan. On that note, is there anything that we've missed or anything that we haven't talked about when it comes to ESG investing that would be good to hit on before we sign off?
No, I think the key points we hit, those are some great questions, and I really appreciate the insightfulness of those. And I really feel like as I spoke out loud, I hear myself as a bit of a broken record, which is sometimes a good thing to hear yourself speak on these issues, because I think you can tell from my comments that really the next step for investment committees isn't so much what product are we going to use, or what's the solution for our participants. It's really more about organizationally, what is the goal that we're trying to accomplish here, and educate themselves and work with partners like yourself that are digging into these issues and that can help them understand what's the right path forward for their plan. Because it would be insincere of me to say that every plan is going to address it the same way. And that's part of why you work with folks that can help you navigate through that. Because I think investment committees are looking to satisfy their participant population. And often what you read about in the papers or in the media tries to paint a very homogeneous picture of a single issue. So I think plan sponsors and investment committees that have that fiduciary responsibility to their participants really have some difficult answers to, or some difficult questions to answer before they can really address this. And staying out of the marketing spin and looking at the issue for what it is probably the first next step, and probably the hardest step for investment committees to take.
No, and I think just like so many other things that will kind of come across the desk or will get put on the agenda at an investment committee meeting, I think this makes absolute sense for folks to have as an agenda item. And then to your point, where it goes from there is really going to be based on the goals, the population, the objectives of the company. And hey, this could be asked and answered. Yep, not for us. Or, wow, tell me more. What are our options? What should we be thinking about? How do we consider if this makes sense for us? What's the risk? All of those. I think that gives a committee an opportunity to really have a very different type of discussion as well. And to your point, maybe a broader discussion about creating more alignment within their population than they have right now, not just in their retirement plan, but maybe in other areas of their business too. Crazy, but that might be an outcome.
Well, a good example of that, Rick. So it's a great point, because before being in this role, I spent a decade here at MFS working in our institutional group, and I worked directly with large companies and plan sponsors and governments. And it's remarkable. You go to these companies, and I won't use any by name, but you can go to some of these companies that have remarkably clear corporate sustainability programs. These aren't sustainability programs that they have just for marketing purposes. They're very well thought out, aligned with their long-term objectives, their reinforcing of their competitive advantages in the market. So it's clearly something that they take very seriously, because as companies that are well run, looking out over a long period of time, they're always looking at almost like an R&D. What's the next decade look like for us? We better understand these issues. If we're a soft drink company, we better understand where to source clean water, or how to build more healthy product to fight the obesity epidemic. So these companies think about that really, really deeply. And then you go to their treasury department and talk about their $10-20 billion long-term assets and pension and defined contribution, and they're like, what is this ESG thing? So the disparity between corporate strategy and the long-term investment capital that their participants have access to, that they're fiduciaries over on behalf of their employees, it's quite disparate. And so I'm sort of pointing out a mega size company, but you can bring it all the way down into smaller size plans. What is the organizational philosophy and belief on some of these issues? And then how does the retirement plan become coherent with that? So it's not just a DC issue. It's not just an ESG investment issue. It's a much bigger issue. And we're not talking about boiling the ocean here. I mean, you don't have to, spend 2 years building a really robust strategy around it, but just having some organizational coherence on these issues is important for your employees, whether it's retirement plan or otherwise. So I do think that there's good opportunity for companies to address that. And one best practice that I would highly recommend that you see all the time with very large companies, you don't see it so often with mid-sized companies, is just education. So having the investment committee invite in practitioners. We participate in a lot of education days for these investment committees where they might talk to an ESG product provider, someone that's out there talking about X firearms, X carbon. And they might talk to a manager that's talking about ESG as the right path forward. They might talk to a data provider in the space and get a lot of information kind of across the spectrum on this issue, so that then they can come together as an investment committee and say, or as an organization and say, what's our view on this and how do we want to move forward? So I would highly recommend that these committees spend the time, just carve out an hour on an agenda and do education. Maybe bring in 2 providers, half an hour each, and get 2 different views. And over time, maybe you put a 6-month plan in place where over 6 months you hope to have enough education to make a decision and a path forward. And then you have that, you document it all, you put it in your fiduciary folder, and you've got a well-articulated approach towards addressing this issue as a DC fiduciary. So, those are examples of things that aren't super difficult to do, but can sometimes fall down on the priority list. And, as we talk about this topic, it's something that if an organization wants to prioritize it, it's something that they could consider.
I love it. And I really appreciate everything you shared today. I think that's a great spot to wrap. And certainly, I think this is an evolving conversation, and loved your insights, and would love to have you back sometime down the road and take another crack at this as when it makes sense.
Yeah, we'll see if my prediction comes true.
Right. I love it. Awesome.
Yeah, well, I appreciate it, Rick. Thanks for the time and the questions, and we appreciate it.
Absolutely. No, thank you. And I appreciate your time and your insight. Well, there you have it. My conversation with Sean Kenny of MFS Investment Management about all things ESG. On a total side note, Sean is also the name of my son, spelled the same way. So just fun for me to talk to other Seans out there in the world. That was highly informative for me, hopefully informative for you as well, about ESG, what it is, the role they play in 401k plans. Going forward on the podcast, we have some great stuff in store. One of our next new episodes should be an excellent conversation with the leader of a major record-keeping group about what is going on in the mega plans and what is likely to filter down to other plans that are maybe a little bit smaller or don't quite have the economies of scale or resources that they do at their fingertips. And also what some of those employers are doing to become an employer of choice or use their 401k to truly create differentiation for themselves in the marketplace. And we're going to tackle a topic that came in from a listener and talk about the current state of retirement plan education, what's going on, what's working, what's not working to help employees improve retirement outcomes. So stay tuned for some great new episodes in the future. As always, thank you for listening. And if you've been enjoying the podcast, please share on social media, whether that be through LinkedIn or Twitter, whatever it may be. We certainly appreciate that. The more new listeners we have, the bigger the podcast grows, and the easier it is for me to convince great guests like Sean and others to come on and join me and share their timely and relevant information about workplace retirement plans. So until next time, I hope you make your Friday a 401k Friday. And now for some disclosures. The content in this podcast is provided for educational and discussion purposes only. Investing involves risk, including a potential loss of investment. Lockton does not and cannot guarantee the future performance or specific level of performance, the success of any investment, or success of any strategy. Nothing contained herein may be construed as investment or legal advice.